Hey, good morning, everyone. Marty Mazzora here. It's Friday, the 21st of November, 2025, with your end-of-week update. Going to share with you the latest from our internal notes, which I did happen to post on the blog site as well. So those of you who just wait for the videos, I want to at least paraphrase the latest commentary and kind of an update to at least our near-term narrative. So we'll do that, won't take too long, and then we'll run through some charts. So to begin with, the note I posted yesterday morning when the market was rallying really hard, that we woke up to a Dow that was up over 600 points. The S&P, I want to say, was up well over 1.5% at one time. The NASDAQ 100 index was up over 2%. And they were coming off of those highs a little bit when I started writing here at 8:14 a.m. Pacific time. But here's what I said. Equities are rallying hard on NVIDIA's positive earnings report. Although they were off of earlier highs, the delayed September jobs data was released this morning, which showed a 119,000 payroll increase. And by the way, the expectation was for 50. So it was notably better. However, the unemployment rate rose to 4.4. Labor force participation was unchanged. Average hourly earnings, 0.2%, 3.8 year over year. That was a disappointment, and that was a slowing of the growth there. Work week stayed the same at 34.2 hours. Interestingly, July and August were revised lower by 33,000 jobs, and August actually showed a loss of 4,000 jobs. The BLS is not delivering the October data despite having everything they need for the establishment report. There's two pieces, the establishment report and the household survey. The household survey is where they glean the unemployment rate and the labor force participation rate. So they said, we don't want to tell you about job creation because of this. We're going to wait for early December. At least that's what you would have thought initially, because it's always released on the first Friday of the month, where we will blend the October with the November data. And then we just heard that they want to delay that until December 16th. Thing is, the Fed is meeting on the 9th and the 10th. So we're not going to get any more jobs data from the Bureau of Labor Statistics until after the December meeting. Now, the scuttlebutt is that the October data was probably very weak coming from the establishment report because of layoff announcements, job openings kind of falling off a cliff of late, the warn notices where companies who are going to lay off a certain number of people have to warn their respective states a certain period of time ahead of time. That has spiked higher. So it makes sense that October data was probably pretty weak. And of course, lots of people are not shy about suggesting that this was on purpose. They don't want to show that. Well, they're saying that they want to give you the whole report, but they don't want to give it independent of November. So whatever all that means, I'm a little frustrated that they're waiting till December 16th. Of course, they're saying that, we need more time because of the government shutdown. So, okay. It'll be interesting. So here's what I said. It'll be interesting to see if equities can hold this rally considering the September jobs number. Now, markets actually boosted up a little more on the positive payroll increase. The reason I say it'll be interesting, implying that I'm skeptical, is because my view, or our view, is that the way the market has been trading equities of late is that they've been very much reacting to odds of a rate cut in December. And when the odds decline, stocks seem to go with them. And when the odds improve, stocks seem to go higher. So my view, again, as I just said, has been that the December cut is essential to the prospects for a strong year-end finish. Crypto was selling off hard while stocks were rallying hard, and that's been a pretty good tell. Crypto is kind of the early stage liquidity indicator these days, and very reactionary to Fed prospects. Although this morning, as I speak to you, stocks are catching a bit of a bid, and crypto really isn't expressing that. And I'll talk about what has been said by one particular Fed member that clearly is helping the market this morning. So again, as I was typing yesterday at that time, the S&P was off of the morning highs. It was up about 1.1% when I finished this little commentary here. And then literally 45 minutes later, and sooner than I expected, the S&P had rolled over hard. It was down over 1%. The Dow was down 200 or 300 points. And I'm guessing that the withheld October jobs data is notably weak, consistent with layoff announcements. If other data confirm between now and the next jobs report that December rate cut odds, consistent with some Fed commentary yesterday, could bolster equities along the way. So what I'm saying there, I think I jumped ahead of myself here, is that, first of all, the market had rolled over. And I think the market had realized that the September jobs number would in no way, shape, or form inspire the Fed to cut interest rates in December. Remember, it was 119,000 versus 50,000 anticipated. And then they're going to withhold, the rest of the data that could be weaker until after the Fed meeting, so the market would imply that the government doesn't want to give it bad news. What the government, if you will, doesn't seem to understand is that if first and foremost they want to keep this market buoyed, and that's what I'm going to share with you in my next commentary that I think they do, then the best thing for them right now would be a relatively weak jobs number and get the Fed to cut interest rates in December. Just the day before, this I didn't publish, but this I just did internally for our purposes. I just said if the Fed starts signaling a rate cut in December and NVIDIA doesn't disappoint, the S&P tops 7,000 by year end. Commodities rally on lower yields, lower dollar, and prospects for fiscal next year, and then crypto rallies. Or data come in strong, and they did. That was the September jobs number. Fed stays hawkish. NVIDIA doesn't matter, is what I said. The S&P will correct another 5 to 10%. It'll go down another 5% to 10% by year end. So notice what I was saying on the 18th before the news that inspired the paragraphs that I just read to you. I said that if the data come in strong and the Fed stays hawkish, NVIDIA doesn't matter. Well, NVIDIA mattered for a while because the market rallied nicely on it. But once the stronger data got digested, the market rolled over very, very hard. And I said that gold will drop 10 to 20% on a stronger dollar, and gold had a rough day as well. And I said that crypto will tank, and crypto did tank. However, it's still not coming back. And again, we're not having a rip-roaring rally in stocks right now, but crypto it did get a pop when Fed Governor Williams, and that's the other news, this morning came out and said, yeah, I think we can cut rates in December. And as you'll gather from my next read here, I think the Fed will react to a lower stock market. Okay, so this was the longer one. I actually posted this in its entirety on the written blog. I would highly suggest you read that, but I'll just paraphrase it for you. Suffice to say that the stock market is bigly essential to the overall health of the U.S. economy. The K-shaped nature of present conditions demands that the wealth effect remains alive and well if this expansion is going to continue. K-shaped economy. Upper part of the K represents people who own assets, say stocks and other assets, and have a good income. The lower part of the K is everybody else, people who don't own a lot of assets and are on the lower half of the income distribution. These people are suffering mightily. These people are doing great, and these people are absolutely doing the lion's share of consumption, which continues to help keep the economy afloat. These people are hurting. So you can't have, if you're desperate to avoid recession, you can't have the top half of the K rolling over because their portfolios are declining and suddenly they're losing confidence. So this scenario is no way, shape, or form lost on Washington. I watched Scott Bessent, the Treasury Secretary, the other day announce in an interview that by mid-next year there will be what he called Trump accounts established for every newborn American baby retroactive to 1/1/25. They will be funded with $1,000 that will have to be held in the U.S. stock market. Talk about being desperate to keep stocks afloat. Essentially, taxpayer money directly into the stock market, keeping the upper half of the K clicking right along with babies as the conduit. The need for such measures is quite clear in my view. We are essentially reliving the dot-com setup in that a bear market in stocks, I believe strongly, would be the catalyst for an economic recession, given where the market is, how instrumental it is or how important it is to keep the economy going, call it the wealth effect. And therefore, for political reasons, the stock market is hugely the focus. Now, in no way, shape, or form do I want to discount the credit markets, which essentially is where all the liquidity and everything happens. That's even bigger, but that the Fed has umpteen different facilities as they've proven to jump in and remedy short-term liquidity issues. Stock market's a little different animal, and it does respond big time to liquidity. So if they can keep the credit markets going but stocks begin to roll over, then I think we will see action on behalf of what is a very systemically important U.S. stock market, particularly in these big tech names. So again, I'm kind of reading the whole thing to you, I guess, but the political motivation to keep the market afloat is huge right here. I anticipate notable tariff relief over coming months, along with generally friendlier geopolitical rhetoric coming from U.S. policymakers, and potentially yet more pro-market schemes akin to the Trump accounts being hatched. Then there's the Fed. The market is having a rough go of it of late, based largely on the fact that Fed funds futures have suddenly priced in less than a 50% chance of a rate cut in December. 1 month ago, those odds were 90%. Should equities continue to fall, the Fed will no doubt grow very concerned about the risks that they'll cause, i.e. be blamed for, the dynamic that will bring on the next recession, i.e. all else equal, they will be cutting rates. Yesterday, while the market was free falling, 2 Fed governors said, hey, a December rate cut is clearly on the table. The market was up a little bit this morning, started rolling over. Fed Governor Williams came in, suggested that they'll be cutting rates in December, that he will be in favor of that. Market caught a bid right on that news. But here's the thing. I said all else equal. Thing is, all else is never equal. The not small risk for stocks in the above narrative is inflation. Considering all the fiscal help coming to the market, the big beautiful bill act as it's called, included, and a deer in the headlights Fed, assuming this all works to boost the market and the economy, there will very likely be no let up in inflation. In fact, I would say the opposite. In fact, putting pressure out the curve, pushing mortgage rates higher, and very much calling into question the prospects for, in particular, the large tech stocks whose multiples, whose valuations are priced for more than perfection. Yada yada, taking longer than I thought. Largely with regard to tech stocks, a lot of ink has been spilled of late on the topic. I've been pounding on herein, as you know, the massive capex spent on AI databases and the prospects for it not ultimately culminating any differently than all of history's capex blowouts over game-changing technologies. If when those chickens come home to roost, akin to the dot-com bubble bursting, Fed intervention by itself will not do the trick. It would take COVID-like junk bond-style direct government purchases of these now systemically important company stocks to arrest a major protracted decline. And I would fully expect that to ultimately occur. Not on the first 10 or 20% drop, by the way, but it gets worse and it looks like it's going to be durable. I think they get very active like they did in the junk bond market, which in my view was illegal for the Fed to do that. But they figured it out with the Treasury. I think they'll figure this out as well. In fact, per the Trump accounts and I think more, they're already figuring that out, how to basically use government funds to buy U.S. stocks. Now, here's kind of the punchline. Inflation, by the way, is actually a necessity, more so than it is a curse. As I pounded here over the last couple of years, not so much of late, but I did extensive one-year-end letter, I think was largely devoted to this, and that is the debt to GDP problem in the U.S. We won't redo that here because it'll take too long, but basically the way the U.S. gets out of trouble like this is to inflate away the debt. So we do have this need to run large fiscal deficits as far as the eye can see. To remedy that is to allow the economy to run hot with inflation, obviously, while capping the cost of Treasury debt all the way out the curve. It would be called yield curve control, and that was the tack taken between 43 and 52, which brought the debt from 116%, the only other time in history we were above 100%, to a very manageable 80%. That is the recipe. Ultimately, we're not doing it yet. Some would argue that we are in a way, but we're doing it very stealthily. But an outright, World War II or Japan-style yield curve control is yet to be done, but I don't know how we don't do something very akin to that with the issues that we have with the huge debt and the huge deficits that we're going to continue to run, particularly in this populist era that we have now entered. So, folks, what am I saying here? That the U.S. market is a systemic liability right here for the economy and for policymakers and politicians. So they will move heaven and earth to try to keep a tech bubble burst type scenario or the great financial crisis 2008 type scenario from happening while bailing out the consumer a la COVID along the way. So if they succeed, we get COVID type 40% bear markets that last 3 weeks, right? Or maybe not that deep, but the cavalry showing up very, very quickly with infinite amounts of liquidity. If it works, there is a cost, and the cost is inflation, higher mortgage rates, and I mentioned populism. In that environment, you're going to have to give people lots and lots of money to keep them from burning the house down. It strongly suggests a weaker dollar, strongly suggests we should allocate to things like gold, other commodities, non-U.S. stocks, particularly in regions that produce commodities and so forth. And this would be a structural longer-term thesis. There is this interesting stablecoin phenomenon which will provide some external strength for the dollar, and that's a topic that we will be wading into, no doubt about it, in coming months for sure. But right now, I'll just leave you there. So there is a little bit of tailwind for the dollar, I guess, in that scenario over the next 10, 15 years. More so at the latter end of that, but a very interesting scenario that will be developing over the next few years. Internally, the dollar will be weak, and U.S. consumers will see inflation. That is our thesis. As we sit here today, we think it's very solidly grounded, but of course we are, if anything, we are open-minded and willing to change tack as conditions tell us to. Okay, so jumping to some charts for you. Just for starters, this week we actually cut our exposure to U.S. small cap stocks, which have been correlating too much to the big tech sector of late. We cut it in half, and we took half of our proceeds from that and we bought U.S. staple stocks. A fourth of the proceeds we bought healthcare, and a fourth we bought more of our uranium miners position, which has been correcting quite a bit lately, which we think is a very solid long-term place to be with some money. So what I wanted to show here is just the last couple weeks or so of correlations, and what we've been noticing is quite notable rotation. So in the last 15 trading days, tech stocks are down 10%. So that's quite the sell-off. All the while, consumer staple stocks, which are flat on the year, they're just now moving into the positive, are up 2%, right? And healthcare is actually up 7%. Today, for example, the market's come off the mat a little bit. Actually, it was down. Tech stocks were down about 1%. They're flat right now. So tech stocks are flat on the morning. They started lower, and now they've come back. But by the way, consumer staples are up well over 1%, and healthcare is up about 2% on the morning. And when this was down, these guys were up like 1% respectively as well. So we are seeing, on the down days, we are seeing very strong rotation away from tech stocks into what are considered, more economically defensive, and a much more attractive look here, particularly in stables and healthcare as well, from a reversion to the mean in terms of where they should be trading if the market were showing much better breadth. And from an overall valuation perspective, there's nothing more expensive than the tech sector right now in the U.S. So essentially taking a little risk off while still staying in equities. Now looking at those specifically, our consumer staples ETF, you can see it had been trading lower quite a bit lately. Now we had bullish divergence. Okay, I haven't shown you this on a lot of things of late, but we have bullish divergence, at least on the MACD and momentum, while the sector was falling. As of today, we're breaking through this downtrend line. That's very positive when you have these looks here on the MACD and the RSI, which are momentum. As for healthcare, it's had a better run of late, right? Kind of a rising channel. and we don't have anything bearish. This actually confirms the uptick, and you can see this big, huge candle. So we've been kind of consolidating in here, right? And today we're breaking out of that range to the upside. That's very encouraging. The shape of this, the shape of the flag is not quite a bull flag pattern, so we're not really retracing, but we're consolidating sideways, but that might suggest that we've got quite a bit more upside to be had in healthcare. And you can see the momentum has been building. We are overbought right here. That's a short-term warning sign. And you would say right now, at least on the RSI, that would be actually a little bit of a negative divergence, not on the MACD, but on the RSI. So that's just when something's moved very, very quickly. This confirms it. This questions it. Okay, so the S&P itself, the other day, I think it was the last video, I said, wouldn't surprise me to see the 50-day moving average hold like it did here. It did for a day, and then it fell apart. You can see yesterday, this is what we got, that rally early on, and then just plummeted, and here we are actually, you know, making a little bit of a gain here today. But nothing really inspiring on momentum, and this is what I've been showing you for a very, very long time. Same thing on the NASDAQ 100 index, or the ETF that tracks it. Lost the 20-day, lost the 50-day with momentum. Still struggling. Right now, we're probably right on the flat line there. Going to get oversold here pretty quick. So, folks, the longer term, these technicals are looking very problematic to me. And again, only looking at it technically. Do not be surprised, particularly if more Fed governors come out and say a December rate cut is likely. Do not be surprised if we get that Santa Claus rally, which typically is a post-Thanksgiving all the way through the first week of January phenomenon. Pretty strong seasonality. No way that it has to happen. A lot can get in the way, but I would argue that this sell-off actually kind of plays into it. A lot of people got scared. A lot of people got spooked. Sentiment dropped like a rock. Little good news, you know, more tariff relief, peace in Ukraine. I mean, I come up with lots of things that you could see just a pretty good bounce. I'm not saying that it's going to happen, but it would not surprise me. And then once again, you blow through these technicals, and this would become a false breakdown. Beyond that, longer term, this concerns me very much, to be honest with you. And then real quick, let's just look at rate cut odds. 2 days ago, folks, that was 27%. If you want to know why the market's rallying today, this is it. This is very consistent with what I just read to you from my commentary. And that is that the market right now is hyper-focused on the Fed, at least for now. That can change, but that is a monster move. Yesterday it was like 32%. So odds of a Fed rate cut have doubled. And as I speak, the S&P is now up 1%. There you go, folks. It was down when I started the video, okay? NASDAQ 100 is up 0.5%. Dow's up, 1.2%. By the way, this pretty much covers our core allocation. There's some things in here that are just placeholders, but we own Delcath. I'm not making recommendations, folks, but we own this biotech, which we believe there's a good potential thesis there. It's up 10% today. We own Deckers. It's up. We just bought Deckers like a week ago, and it's up nicely since we bought it. Materials are up a bunch. Applied Materials is up a bunch. Small caps are rallying hard today. AT&T is up a bunch, and so forth. Even gold is catching a little bit right now. It was down earlier. Things that aren't working this morning are silver, one of our emerging markets ETFs. The euro is not a position. That's a placeholder. Ag commodities are positions. They're down today. Local currency, emerging market debt. Emerging markets aren't cooperating here is what this shows us. South Africa, what's been a phenomenal stock for us is this Chilean lithium miner is off this morning. It was up 10% the other day. India's off a little bit. Uranium's off a little bit. Technip, which is an energy company in Europe, which has been a really good position for us, is off a bit, but the VIX is down 7.4. So the majority of our positions are nicely in the green so far today. Folks, any of you watching this who aren't clients, do not consider any of this recommendations. I'm going to say that over and over again. Do your own work or talk to your own advisor. But these videos are really meant for clients and not making recommendations to anybody. Okay, so back to the chart. Dollar's catching a little bit of a bid today. That might just be rotation into U.S. assets. Lower interest rates would be bearish for the dollar, so we'll see how that plays out. The 10-year yield is falling today. That makes sense to me, and you can see it had a big drop yesterday. Gold, as I mentioned, is catching a little bit of a rally right now. You can see it's been living on this. This is the ETF that tracks it. It's been living right here on this line right now, finding some support. And we already looked at interest rate probability. So, folks, I'm going to do a hard stop right there. Thank you so much, as always, for watching and listening. I hope you all have a wonderful weekend. And, of course, I will be back next week. Take care. Bye-bye.